Hey guys, how are you? I hope all of you are doing really good. Welcome to Economics of Finance Excellency batch. And if you are watching it for the first time, please do not forget to subscribe to the channel and share with all your friends. Okay, so what we have been discussing about, sir, we have been discussing about the fiscal policy. And in the last lecture, we discussed about the various instruments of fiscal policy, which is very important from examination point of view also. That taxes, what are taxes, what is government expenditure, what is the public debt, and then the government budget, right? Now, in this lecture, what we are going to talk about is another very important element of this particular chapter, that is the types of fiscal policy. Very important component. Only this topic we are going to cover in this lecture, and the remaining topics we'll cover it up in the next lecture and complete this particular chapter, right? So basically, when you are talking about the types of fiscal policy, they say there are two types of conditions in the economy, right? What are those two conditions? One is the inflation and another one is the recession period, right? So based on the inflation and the recession, there are two fiscal policies which are there, right? So types of fiscal policies two. One is the expansionary fiscal policy. Now, what is expansionary fiscal policy? That means expansion. Expansion means to increase something, right? To increase means when we are talking about the fiscal policy, they say it is what is the main motive of the fiscal policy? That is economic welfare, right? Or what we call it as that you need to increase the disposable income in the hands of people. You need to increase the aggregate demand, right? So expansion means you need to increase something. Increase what? Increase the overall economic welfare. How can you increase the overall economic welfare? Through increasing the disposable income in the hands of people and through increasing the aggregate demand, isn't it? So when is this situation? When you have to increase the disposable income and increase the aggregate demand, sir, during the times of recession. That means this expansion policy is adopted during the economic recession or depression, right? So what I have done, I have correlated with the things that I told you in the last lecture also, right? The linkages that we build up. So what the government is doing under this policy, the government may lower the personal taxes and corporate taxes, obviously to increase the disposable income in the hands of people, increase the levels of government spending, government expenditure. The government will increase its expenditure so that the people have more money at their disposal, reduce the government borrowing and increase the budget deficit. That is, we have already studied about deficit budget here, when the expenditure is more than the income. So what will happen with all these steps? All these steps will lead to higher disposable income. All these steps will lead to higher disposable income, right? And higher disposable income will lead to increase in aggregate demand, will lead to increase in aggregate demand, right? So which is that is the main motive. If you want an economy to come out of recession, you will have to follow these steps. You will have to increase the disposable income in the hands of people, which will increase their demand. Because what is happening during the times of recession, the demand of the product reduces, right? And the reduction in the demand leads to what? The reduction in the prices, and the reduction in the prices leads to recession. So you have to correct this circle. Clear? So what is the impact of this policy? High levels of disposable income, already told to you, and the increase in the consumption levels of household. Why there is an increase in the consumption level? Because now the household has higher disposable income. Increase in investment by the firms due to the lower corporate taxes. Obviously, if the corporate taxes are on the lower side, the firms will be retaining more money out of whatever the profits they are earning, right? So with that retention money, they can invest and they can earn, right? Higher consumption and investment stimulates the economy and increases the aggregate demand. That is quite obvious, right? Now, next it says that the expansionary fiscal policy will be successful only if there is accommodative monetary policy. Now, what does it mean by accommodative monetary policy? That he says it's fine. The government will be lowering the taxes. Then the government will do the expenditure and all those things. But at the same time, the central bank policies should be in line with this expansionary policy. That is what is known as accommodative monetary policy. One thing I say that central bank, right? What I am saying is that central bank policies should be in line with this policy, should be in line with this policy, right? Sir, what do you mean by this? When we are saying that the central bank policies should be in line with this, what does it actually mean? It means that the central bank should also be taking certain steps by which the households or the corporate sector have more disposable income in hand. What are the steps which can be taken by the central bank? For example, the biggest step will be lowering of interest rates. Lowering of interest rate, right? Now, if the central bank lowers the interest rate, the people can borrow the money at lower interest rates, right? Now, when people can borrow the money at the lower interest rate, they have to pay less. They will have more disposable money at hand. Obviously, sir. Now, when they are having more disposable money in hand, that will increase the aggregate demand. That will increase the aggregate demand. That is but obvious, right? That will stimulate the economy. That is why it says that the expansionary fiscal policy will be successful only if there is accommodative monetary policy, right? Only if there is accommodative monetary policy, that even the central bank is ready to accommodate this expansionary fiscal policy. The central bank is ready to take up the certain actions or the certain policies which are in line with this expansionary fiscal policy, right? Then we have the recessionary gap or the contractionary gap. Now, what happens during the recession and how it is being corrected through this expansionary fiscal policy, that is what is being told here. Now, what is a recessionary gap or a contractionary gap? He says it arises, the gap arises if the existing levels of aggregate production is less than what would be produced with the full employment of resources. Now, if he says that if you are full employment, if there is full employment of all the resources, right, you can manufacture, let's say, 1 lakh units of a product, right? But if this full employment is not there, if it is less than full employment, if it is less than full employment, then you are manufacturing only 80,000 units. Clear? Now, this gap of 20,000 units, this gap of 20,000 units is known as recessionary gap or the contractionary gap. Why it is being called so? Why there is a gap? Why there is no full employment? Why there is a gap of this 20,000 units? Because, sir, there is no demand. Simple. Why there is a gap? Why there is no full employment? Why there is a gap of this 20,000 units? Because, sir, there is no demand of the product. Why there is a no demand? Because the economy is going through a recessionary period where the people don't have enough money in hand, right? So the aggregate demand is not sufficient to create the conditions of full employment. That is what he's saying. Why there is a gap? Why there is no full employment? Because there is no demand for the product. If there is no demand, why will a particular factory or a particular industry will manufacture the goods which have no demand or which have less demand? Right? Everyone will be going according to what is being demanded, and when the economy is going through the recessionary period, the aggregate demand is lower, and when there is no lower aggregate demand, that will create this gap, right? So that is what is being told here. Now, this diagram is very important to understand, right? If you are able to understand this diagram, so he says in this diagram, what is he trying to say? He says this y1, what is this y1 and what is this y2? This is the output at full employment. That if all the resources are being employed, this is the output at full employment. That if we employ all the resources, this is what we can manufacture. And what is y1? y1 is output at less than full employment. Clear? This much is clear. Now he says in the recessionary gap, the economy is manufacturing what? The economy is manufacturing y1. right? At Y1, this is being supplied, AS1 is the supply curve, and AD1, that is the demand, this is being demanded at the price P1, right? Now this is a recession that is going on. The prices are low, demand is low. So AD1 is the demand, this is the demand, and according to demand, this is the supply. I hope this much is clear, right? So at Y1, this is what is being supplied and this is what is being demanded, right? So this is what is given here. The real GDP is OY1. The real GDP means what is actually being manufactured. Then the natural level of GDP, natural level means at full employment level, what could have been manufactured. Now, there are two different views of the economist. One was the classical economist, the old stylish economists. Those economists say that why these factories are not producing, why they are not giving this particular supply, right? So they say if you reduce the wages of the person who is working there, the wages are flexible. If you reduce the wages, what will happen with the reduction in the wages? Sir, reduction in the wages will lead to reduction in the production cost. This much is clear. Reduction in the wages will lead to reduction in what? The production cost. And with the reduced production cost, they say the companies can manufacture more and supply more. Earlier they are manufacturing Y1, right? Now those economists says if they reduce the cost, if they reduce their cost, the production cost, if they cut down on the wages, the production cost will come down, and with the reduced production cost, they can manufacture more, they can supply more, right? So they say this supply will increase from AS1 to AS2, right? So this is AS2, demand is AD1, this is AS2 being manufactured, and the economy will reach the full employment level. So this was one viewpoint, right? That you go from here to here, the supply has been increased with the reduction in the wages and the production cost, right? Now the manufacturer says, okay, my cost is now reduced, I can manufacture more units, right? The demand will remain AD1 only. Clear? So this was one viewpoint. Then come the Keynes, right? We have already studied about the Keynesian theory also, isn't it? Chapter number 2, the Keynesian theory we have studied about. The Keynes was of the different view. The Keynes says in the actual scenario, the wages are not flexible. Obviously, sir, why would a worker, accept the lower wages? The worker will say, I have been working, right? I need full wages. Why I should be bearing anything? Why the cut on my wages? No, please pay me the full wages. So in that case, the Keynes say this supply curve will not move like this, right? So I will remove now. I'll remove this. Now what the Keynes is saying, the Keynes says in that case, the supply curve will remain this only, right? As per the Keynes. He says the supply curve will remain this only. Whereas with the government expenditure or with the government following the fiscal policies, the demand will increase from AD1 to AD2, right? So this is the level at which there is full employment. The demand has increased from AD1 to AD2, and this is the supply curve, and where the demand AD2 meets the supply curve, that is where there is full employment level. The prices will be there, demand will be there, sufficient price levels will be there, right? And the economy will expand, isn't it? According to the classical view, if you reduce at this level, here the prices will further come down. Sir, the economy is already in the recession, and when the prices will further come down because there is no demand for the product, the price, if you increase the supply, there is no demand for that product, what will happen? The prices will come down further. And when the prices are coming down further, the economy is being pushed into the more and more of recession, isn't it? So the classical view was not adopted. Then come the Keynes. The Keynes says this wages is not flexible, and this is not the right viewpoint. He says with the government expenditure or with the other policies, the other fiscal policies, the expansionary fiscal policies, the demand needs to be increased in such a way that it meets the supply, and ultimately when the demand will increase and try to match with the supply, that is where the full employment level can be reached, right? So this is what the explanation is given to you of this particular diagram, right? He says Real GDP is O by 1 and the natural GDP is O by 2. This depicts the situation of recessionary gap. The classical economists believe that the flexibility in wages would lead to reduction in the production cost and thereby result in the increased aggregate supply from AS1 to AS2. That with the reduced cost, the the manufacturers can manufacture more, right? And full employment level of O by 2. But however, the prices are coming down, sir. Clear? However, the Keynes argued that the wages are not that flexible, hence the government need to increase its expenditure. This would shift the aggregate demand curve from AD1 to AD2 and increase the output to O by 2. The amount of increase in the government expenditure depends upon the gap between the real and natural level of GDP as well as the size of multiplier, that how quickly the money can multiply, right? In order to finance this rise in the expenditure, the government can opt for the budget deficit, which may be financed through borrowings, or the monetization, which we have already studied about, right? So this is about the expansionary fiscal policy, and if you have understood this diagram, the major parts of this are covered in this. Clear that what is the view of the classical economist and what is the view of the Keynes in this case, right? And why the classical economists were not right? Because if you follow the classical economist, they say they were focused on the supply part, they were not focused on the demand part, right? They say the demand is fine, you increase the supply, right? Sir, demand is already low. If you will increase the supply, the prices will come down further, the economy will go into the recession mode further, right? Clear? So that was the expansionary fiscal policy. Now, on the contrary, the reverse of it is what? The contractionary fiscal policy. The reverse of it is contractionary fiscal policy. It is the reverse of expansionary. Contraction means you have to contract something, right? To reduce something, right? Reduce what? If you talk about from the fiscal policy view, what do you want to reduce? Reduce the money, reduce the disposable income in the hands of people. Why? Because you want to reduce the aggregate demand. And when is this situation where you need to reduce everything? Sir, this situation will arise when the economy is in the inflation mode, right? So this policy is adopted during the inflation in an economy. Under this policy, the government will increase the taxes, reduce the level of spending, increase the borrowing and the surplus budget, right? What will be the impact of this? The lower levels of disposable income, reduced consumption levels of the household, reduced investment by the firms due to higher taxes, and the lower consumption and investment regulates the economy and moderates the unsustainable increase in the aggregate demand, right? Basically, the aggregate demand is being controlled. Now, there we have the recessionary gap. Here we have the inflationary gap. What is the inflationary or the expansionary gap? He says it arises when the aggregate demand rises beyond what the economy can potentially produce at full employing the given resources. He says at the full employment, if the economy can manufacture 1 lakh units, there is a demand for 1,50,000 units. That is due to inflation. What will happen? What will happen, sir, when the demand is more than supply? When the demand is more than supply, what will happen, sir? This will lead to increase in the prices, and increase in prices lead to what? Increase in prices lead to inflation, isn't it? So that is what is here. This is the inflationary gap. You at full employment, you can manufacture 1 lakh units, right? Whereas the demand is for 1,20,000 units. So what is this 20,000 units? This is your inflationary gap that he is talking about, right? So demand increase with a given level of output pushes up the prices and is called the demand pull inflation. So when the inflation is being created due to increased demand beyond what can be manufactured or what can be supplied, that is called as demand pull inflation. That inflation which is caused due to the increase in demand, right? Exponential increase in the demand. The prices of the factors of production increases, leading to increase in the cost of producing the goods and services, and is called the cost push inflation. That when there is more demand, you will try to manufacture more, you will try to supply more, and in the process the factors of production will also increase their prices, leading to the increase in the cost also, right? So that is a cost push inflation. Now this diagram, what is this diagram says? He says the economy is already at the full employment level, right? This is what? This is the output at full employment level. Output at full employment level, right? Now, what the economy is demanding? Sir, economy is demanding something which is beyond this. Economy is demanding this part, right? Now, this is beyond the output which can be manufactured at the full employment level, isn't it? So, this is what? This is what economy is demanding. This is what economy is demanding. Now, how can you correct it, sir? How can you correct it? One way is that you increase the supply. You take the supply from here to here, right? One way is this. You take the supply from here to here, it will reach at this point. But is it possible? No, sir. Right? So, what the government is doing, government says, let's try to control the demand through the various policies, through higher taxes. If people will have less disposable income, they will demand less. So the government says, let's reduce this demand from 82 to 81, whereas this point will come here, right? This is the demand, this is the maximum supply that the economy can do, and this is the right price level. This is what is done in the inflationary gap. In diagram, the real GDP rises beyond the natural level, which causes the prices to fall from OP1 to OP2, right? Rise, not fall, rise from OP1 to OP2 because there is higher demand leads to higher prices. Now it says the rise in the price shift, the supply curve from AS1 to AS2, okay, right, from AS1 to AS2. Although there is an increase in the price level, the real GDP remain unchanged at OY1 because that is already at full employment. How can you manufacture beyond that? So in this case, the adoption of the contractionary policy and consequent reduction in the public expenditure ensures that the aggregate demand does not shift to 82. Right? So the aggregate demand remains at 81. It does not shift to 82. Right? The extent of reduction in the government expenditure depends upon the size of inflationary gap as well as the size of multiplier. Understood? So these two diagrams were important with regard to the expansionary fiscal policy and the contractionary fiscal policy, right? So this one small topic is there, that is fiscal policy in the long run economic growth. That fiscal policy needs to be accompanied with the policies aimed at stimulating the aggregate supply to ensure the long run growth. He says it's okay to focus on the aggregate demand, but at the same time, the policies should be aimed at the aggregate supply also, right? In the earlier lectures also, I told you that the government must make the policies which are in line for the consumers as well as the producers, right? So you have to look at the overall economy. When we are talking about the welfare of the overall economy, in the overall economy, the producers are also there, sir. The producers are also there in the economy, right? So he says the fiscal policies have the significant implications for the long run economic growth. Example, the rise in the public work, greater expenditure on infrastructure project, government provision of public goods have the positive impact on the long run growth. Well-structured tax policies act as the stimulus to investment and thereby help economy grow. So basically, this is a long run concept. Whatever he's saying is that whatever the fiscal policies the government frames, it should be keeping in mind the long run economic growth, not the short run economic growth, right? So we are done up till this point. Now we have just left with the small topics that we'll cover it up in the next lecture and complete this particular chapter, right? So nothing to worry about the syllabus. We'll complete in time for May 2023 and for November 23. This will be fully uploaded, right? So in the next lecture, we'll complete this particular chapter and the complete, as per the ICAI module, we'll be completing this particular unit, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.